Yeah, I mean, it's been significant, but not quite enough yet. I mean, if you look at the home price growth rate, we saw the strongest slowing that we've seen since the peak of the market back in 2006 in the month of May. The downside is it would take more than 12 more months of that same level of slowing to get back down to that normal 3 to 5% rate. So certainly signs of a turn, but still a long way to go.
Why do you think we haven't dropped more?
It's kind of like putting the brakes on a freight train, if you will. I mean, we were running so hot. We were seeing annual home price growth rates above 19%, and the market just doesn't turn overnight. So there are certainly signs that we will continue to move downward. Inventory saw its two largest months of building in May and June. We've gone from a 67% deficit to a 54% deficit. So we're moving in the right direction. We're still sitting on a very strong deficit of inventory, and it continues to put upward pressure on prices.
You know, you'd think that if you were even thinking about selling, you'd go, well, let me definitely sell now in case the market softens further. Why aren't we seeing a rush of people behaving that way?
Yeah, and it isn't yet, right? The reason that inventory is building so far is because of a lack of buying or a slowdown in buying. So that's really why you're seeing those inventory levels grow. If you look at the number of homes hitting the market, they're still kind of at those levels that they have been over the last couple of months. So I think as the market, or if the market continues to transition, I think you'll see more of that type of mentality take place and more folks kind of decide if now is the right time. But for right now, you're seeing folks hold steady and not a whole lot of sale. The other reason behind it is rising inventory is a detractor from listing activity. If you look at the number of homeowners that are sitting on a 3% interest rate, a 2.75 interest rate right now, and looking at the potential of selling and having to go buy in a 5 to 6% interest rate environment, it's kind of a deterrent for a lot of folks to go out there and make that buy-sell type of transaction.
Yeah, or if you even thought, okay, I'm going to sell and rent. I mean, still the only real play you could do is sell and maybe go to somewhere lower cost. And kind of to that point, the impact of mortgage rates doubling in a very short period of time to levels we haven't seen in 15 or 20 years has been surprisingly not that big so far. Is that because there's still a lot of cash buyers or institutional buyers, or this sort of trade down effect I was describing?
Yeah, and I think you will see it. I think it's just going to take some time. I mean, I think you're going to see varied effects and varied timing across the country. If you look at areas like San Francisco, you're already starting to see those markets turn. San Francisco, San Jose, Boise, Austin. You're starting to see some of that. The difference is in markets like Florida that are some of the hottest markets in the country, you still have those massive inventory deficits. So you are seeing that transitionary activity, the sell and move type of activity. But to some degree, those markets are now becoming unaffordable. And so you're seeing some regressionary aspects there as well.
One of the biggest debates on Wall Street, or at least on this show, has been what to do with the home builders when some of them are trading at 2.5, 3, and 4 times forward earnings. You know, not that you necessarily are an analyst, but what do you make of the fundamental demand story for new homes in the next 6, 12, 18 months at this point?
And if you look at undersupply in housing, we've had an undersupply from a building standpoint for the last 10 years. So I think there still is demand out there. And as I mentioned, we're still 54% short on supply. And so I think there is still room for growth there in terms of building and a need for additional building out there in the market. But you are starting to see that landscape shift here over the last few months, certainly.
Yeah, none of it kind of paints a picture to me of a market that's about to fall off a cliff. It sounds like one that's slowing, but you still have this freight train momentum you described. Maybe something I should mention is this point you've made about credit scores, which are dropping. And what are the implications of that?
So really the reason that you're seeing credit scores dropping, and this is on the lending aspect of the market, is when you see rates fall like they have, you see high credit quality borrowers rush into the market and transact. They're the ones that are out there refinancing the most early on when interest rates hit their record lows. As rates begin to rise, those are borrowers that begin to step away from the market. So it isn't necessarily credit loosening that's causing falling interest rates among lending. It's just cyclical behavior as interest rates move. But if you look at the health of the mortgage market as a whole, the average credit score of of a mortgage holder in the U.S. right now is still above 750. It's as strong as we've ever seen it. So from that perspective, right, lending is easing a little bit, but from the perspective of the strength and stability of homeowners out there, it's as strong as we've ever seen.
Very, very interesting. Andy, thanks for letting us check in. We appreciate it.
Yeah, thanks for having me.
Andy Walden with Black Knight.
Shepard Smith here. Thanks for watching CNBC on YouTube.